Hi guys! Enjoy John's analysis.
$126,272. That was the exact price of Bitcoin on October the 6th, 2025. And if you're watching this video right now, if you held Bitcoin through 3 years of patience and volatility and doubt, there's a very specific question you have not answered yet. Not whether Bitcoin goes higher, not whether the cycle is over, not whether the institutions are buying or the ETFs are flowing or the halving cycle still holds. Those are the wrong questions, and they will destroy you. The question is this: when the next major move happens, whether Bitcoin climbs to 150,000 or drops to 40,000, do you have a written, systematic plan for exactly what you do with each piece of your Bitcoin? If the answer is no, this video is the most important 12 minutes of your cycle. And if the answer is yes, stay anyway. Because the data from this cycle shows that most people who thought they had a plan did not execute it when the moment arrived. The market did not take their Bitcoin. Their emotions did. The real story of this cycle. Let us start with what actually happened, because the narrative most people carry about this cycle is not the same as what the data shows. Bitcoin hit its low of $15,479 in November 2022. That moment happened in the rubble of the FTX collapse, with every major financial publication declaring the asset class finished. Senators were calling for bans, founders were being arrested. The word on every financial desk was that this time, Bitcoin was not coming back. From that low, it rallied 716% over approximately 3 years to reach $126,272 on October 6th, 2025, 716%. From a moment of maximum fear, maximum institutional skepticism, and maximum media hostility. Now here is the person who needs to understand this video. They are not a speculator. They are not someone who bought Bitcoin on a whim in late 2021 because a friend told them to. They are someone who accumulated deliberately, who understood the halving mechanics, who survived the FTX crash with their coins intact, who read the on-chain data and held conviction through months when the price sat at $17,000 and every headline said it was over. They watched their position go from 15,000 to 40,000 to 60,000 to 80,000 to 100,000 to 126,000. They felt the weight of that wealth. They thought about what it could mean for their family, their future, their financial independence. And then the price came back down to 100,000, then 90,000, then 80,000. Then in February of 2026, it briefly touched $60,001, the lowest level in over 2 years, with a fear and greed index reading that matched the depths of the Terra Luna collapse. And at every step of that decline, they held. Because they believed in Bitcoin, because they had conviction, because they had told themselves they were a long-term holder, and long-term holders do not sell. What they did not have was a system, and the absence of a system transformed their conviction from a strength into a trap. As of May 2026, Bitcoin is trading around $81,000. That is approximately 36% below the October peak. The people who held through the entire rally from 15,000 to 126,000, and then held through the subsequent decline without a framework, are watching a significant portion of their unrealized gains compress in real time with no protocol for what to do next. This is not criticism. This is the mathematical reality of holding without a system. What the on-chain data shows about holders right now, according to Glassnode data from November 2025, 2.8 million Bitcoin held by short-term holders, defined as those who acquired coins within the previous 155 days, were sitting at a loss. That was the largest concentration of underwater short-term holder supply since the FTX collapse in November 2022, when Bitcoin traded near $15,000. Think about that figure carefully. 2.8 million Bitcoin underwater. Not because these holders bought at the top in a speculative frenzy in the final weeks of a mania, but because they bought between $60,000 and $126,000, which at any point in the previous cycle would have been considered a life-changing extraordinary price, and then watched the market decline without a system for what to do next. And that is the precise moment where the absence of a plan becomes the most expensive financial decision of a cycle. Not the entry, not the exit, the absence of a framework between the two. The behavioral evidence. A Kraken survey conducted in 2024 polled 1,248 crypto holders across the United States. 88% reported regretting missed opportunities for significant returns. 63% believed that emotional decisions had negatively impacted their portfolios. 84% admitted to acting on fear of missing out at some point in their investing history. These are not weak or uninformed investors. These are people who were paying attention, who read the research, followed the on-chain analysts, understood the halving cycle, held through multiple corrections, and still, in the moment that mattered, they made decisions based on how the market made them feel, rather than on a system they had built in advance. Because a system built in advance is emotionally neutral. It was created when the price was irrelevant, when no position was on the line, when no headline was pulling at the decision. A decision made during a rally or during a crash is almost never emotionally neutral. It is made by a version of you that is either euphoric or afraid, and neither of those versions of you should be trusted with financial decisions of this magnitude. The bear case, which you need to hear. Now, before we go further, you need to understand something that most Bitcoin content will not tell you directly. There is a serious data-backed scenario in which October 2025 was the peak of this entire cycle. Fidelity's Director of Global Macro, Jurriën Timmer, has made exactly the case, that the peak of $126,000 was the cycle top, and that 2026 is a dormant year with structural support around $65,000 to $75,000. Noodle's research, using 3 independent on-chain frameworks, NUPL, Loss Supply Deviation, and the Stablecoin Cycle Index, published a base case in April 2026, placing the potential bottom between $34,000 and $50,000, arriving between July and October 2026. This is not fringe analysis. These are serious quantitative frameworks applied consistently across 4 prior cycles with documented historical precedent. The point is not to frighten you. The point is this: if the downside scenario is real, a holder without a system will capitulate somewhere between $40,000 and $60,000 after watching the price fall another 30 to 50% from current levels and sell at exactly the wrong moment. Again, repeating the exact pattern that destroyed wealth in 2018 and 2022. And if the upside scenario is real, if Bitcoin has another leg toward $150,000 in this cycle or the next, a holder without a system will fail to take any partial profits on the way up, hold all the way through the subsequent decline, and find themselves right back in the same conversation in 2028, watching unrealized gains compress again without a framework for what to do. The system is not about predicting which scenario plays out. It is about surviving and prospering regardless of which one does. The 3.27 million Bitcoin question. Since the beginning of 2024, long-term holders, defined as Bitcoin investors who have held for at least 155 days, realized profits of 3.27 million Bitcoin. According to Glassnode data published in August 2025, this figure surpassed the entire 2021 bull run, which recorded just over 3 million Bitcoin in realized profits, and fell short only of the 2017 cycle, which saw 3.93 million Bitcoin distributed. 3.27 million Bitcoin in realized profits in a single cycle, at prices ranging from $30,000 to $126,000. And here is what almost nobody who discusses this figure actually understands about it. They did not sell all at once. They did not time the top. They did not make one perfect decision. At $126,000 and walk away. They did not watch the NUPL hit a specific number and then liquidate everything in a single transaction. They distributed gradually, methodically, and in proportion to price appreciation, across months, not moments. The data shows this clearly in the shape of the realized profit curve. It did not spike at one single moment and collapse. It built steadily, peaked across a range of prices, and declined gradually as distribution completed and accumulation resumed. That shape is not luck. That shape is architecture. The behavioral difference between LTH cohorts. This is the detail that separates the understanding of this cycle from the surface-level narrative. Glassnode's week on-chain report for week 22 of 2025 analyzed the anatomy of the rally to $111,800. The data showed something that most holders never think about. It was specifically the oldest segments of long-term holders, those holding for more than 1 year, not the 6 to 12-month cohort, who were the dominant sellers at the top. Why does that distinction matter? Because the 6 to 12-month cohort, people who bought between roughly late 2024 and mid-2025, had already experienced significant appreciation. They had strong unrealized gains. They had every reason to sell, but the data shows they contributed far less to the distribution peak than the holders who had been accumulating since 2022 and 2023. The older holders, the ones sitting on 500, 600, 700% unrealized gains, distributed at the top. The newer long-term holders mostly held. And this behavioral divergence tells you something important. The holders who had been through prior cycles, who had watched the 2018 decline and the 2022 decline, were the ones who executed, because they had seen what happens to unrealized gains that are never realized. They had a system. Or at minimum, they had the memory of pain that functioned like one. At approximately $1 billion per day in realized profit from LTHs near the peak of $111,000 to $126,000, these were not panic sellers. They were not traders reacting to headlines. They were investors executing a distribution framework that had likely been in place for months, selling into strength, not into fear. By contrast, as of the most recent Glassnode data from week 18 of 2026, with Bitcoin trading around $81,000, that same cohort's realized profit rate had fallen to approximately $180 million per day. Not because they stopped having a plan, because their plan told them to slow distribution at this price level and begin shifting back toward accumulation. That transition from distribution to accumulation, executed systematically at a predefined threshold, is the behavioral signature of the system this video is about. The shrinking pool of sellers. There is one more data point that contextualizes everything else in this cycle. According to on-chain data from October 2024, fewer than 10% of Bitcoin holders were willing to sell their coins at any given price. That figure represents a dramatic compression from 26% in 2021, when the previous bull market was near its peak, and from 64% in 2013, when Bitcoin was still a fringe asset with a volatile and speculative holder base. Each cycle, the percentage of holders willing to sell declines. The market is maturing. The conviction base is deepening and becoming more sophisticated. This does not mean Bitcoin only goes up. The price action of the past 7 months makes that point abundantly clear. It means that the holders who remain are, on average, better informed, more deliberate, and more systematic than the cohorts that came before them. You are participating, if that is the right word, in an increasingly disciplined market. The question is whether your system matches that discipline, because the 10% of holders who are willing to sell are not selling randomly. They are selling according to a plan, and if you do not have one, you are on the wrong side of that asymmetry. You are still here, which tells me something specific about you. Not that you are a Bitcoin maximalist, not that you believe price only goes up, but that you understand something most holders will never fully accept, that the exit is not a moment. The exit is a system, and the system is built before the market moves, not in reaction to it. Let me show you exactly what that system looks like. The 3-layer exit architecture. Every holder of Bitcoin needs to answer 3 questions before the next major price move. Not during it, not after it, not in the middle of a euphoric rally when the answers will be distorted by optimism, and not in the middle of a decline when the answers will be distorted by fear. The first question: what percentage of your Bitcoin will you never sell under any circumstances, regardless of price? The second question: what percentage will you distribute gradually as the price appreciates, and at what specific cost basis-based triggers? The third question: what is your written protocol for reacquisition after partial distribution? And at what conditions do you begin accumulating again? Most exit strategy content addresses the first 2 questions imprecisely, treating them as philosophical positions rather than mechanical commitments, and ignores the third entirely. That is a fundamental error, because the reacquisition protocol is where the long-term wealth difference between holders is actually generated across multiple cycles. Layer 1, the never sell core. Between 50 and 70% of your Bitcoin is your never sell core. This is not your investment portfolio. This is not a position you're managing. This is your conviction allocation, the portion of your holdings that exists because you believe Bitcoin is a fundamentally scarce monetary asset with properties no other asset in human history has possessed simultaneously. 21 million coins, hard-capped in code that has not changed in 16 years. Approximately 1.32 million coins remaining to be mined as of 2026. An estimated 3 to 4 million coins already considered permanently lost, held in wallets whose keys no longer exist, sent to addresses from which they can never be recovered. The effective float is smaller than most participants understand. The never sell core does not move regardless of price. Not at 150,000, not at 200,000, not at 80,000 or 50,000 or 34,000, which is the lower bound of the bear case bottom range, cited by Noodle's research for this cycle. The specific percentage of your never sell core is a personal decision that depends on your financial situation, your time horizon, your other assets, and your honest assessment of your own psychological resilience. But it must be decided in writing today, not in a bull market when you're euphoric, and not in a bear market when you are fearful. Here is why the timing of that decision matters so much. The percentage you choose when Bitcoin is at $81,000 and the market is uncertain and sentiment is neutral is your honest percentage. The percentage you choose when Bitcoin is at 126,000 and every financial media outlet is running headlines about institutional adoption. And generational wealth is probably too small because the euphoria will make you feel like you can afford to hold more. and the percentage you choose when Bitcoin is at 40,000, and every headline is catastrophic, and the fear and greed index is reading single digits, is probably too large, because the fear will make you feel like you need to protect everything you have left. Write the number now. Write it in a document, not in your head. Date it, and commit to not changing it for at least 30 days, so that short-term price movements do not corrupt a decision that needs to be made with a clear mind. That number does not move. Layer 2, the distribution ladder. The remaining 30 to 50% of your position, whatever is left after you have committed your never sell core, operates on a graduated distribution framework with 3 predefined rungs. Each rung is defined by a trigger, not by how you feel about the market on a given day, not by what an analyst you respect said on a podcast that week, not by the price movement of the previous 48 hours. A trigger is a specific pre-written condition that, when met, automatically initiates a specific action. No deliberation required, no emotional evaluation. The condition is met, the action is taken, the decision was already made. Rung 1, capital recovery. You sell the minimum quantity of Bitcoin needed to fully recover your original invested capital when your total position's unrealized return reaches a predetermined threshold. The specific threshold depends on your entry price and your personal financial circumstances, but the logic behind it is absolute and non-negotiable. Once your initial capital is recovered, every remaining Bitcoin in your position has a cost basis of 0. You cannot lose money on an asset you got for free. Psychologically and financially, this changes everything about how you hold. The anxiety of watching unrealized gains compress disappears. The fear of a catastrophic decline loses its teeth. You have already won, in the most concrete sense of that word. If your average cost basis is $25,000 and you hold 1 Bitcoin, rung 1 might trigger when the price reaches $50,000, a 100% return. At that point, you sell enough Bitcoin to recover your $25,000 in original capital. The remainder of your position continues to appreciate with 0 downside risk to your initial investment. This rung should trigger earlier than most holders are comfortable with. The instinct, especially in a bull market, is to hold everything until the top, recover capital and take profit simultaneously, and walk away with maximum gain. That instinct has destroyed more Bitcoin wealth than any bear market in history, because nobody knows where the top is, and waiting to recover capital at the top means you might recover it on the way down instead, or never. Rung 2, significant profit realization. You distribute a second tranche at a second predetermined trigger, typically when your total position has returned between 200 and 400% on your original invested capital. This is not the top. This is not a prediction of where price will peak. This is a systematic capture of meaningful, life-changing gains that protects you from the well-documented pattern of watching significant unrealized profits disappear in a post-peak decline. Consider what a 300% return on a position built at $25,000 means in real terms. It means the price has reached $100,000. It means you have gains that could change the material conditions of your life. Rung 2 acknowledges that reality and converts a portion of it, the portion outside your never sell core, into realized capital that no subsequent market move can touch. The size of the Rung 2 distribution is again a personal decision based on your financial situation. But it should be meaningful, not a token sale of 2 or 3% that has no real impact on your financial position. Rung 3, cycle signal distribution. This is the most sophisticated rung and the one that requires the most preparation. You distribute a final tranche from your layer 2 position when multiple on-chain cycle indicators, not price alone, converge to signal late-stage market conditions. The specific metrics to monitor are 3. First, the NUPL, net unrealized profit and loss, approaching or entering the euphoria zone above 50%, which historically has corresponded to late bull market conditions, where the average Bitcoin holder is sitting on more than 50% unrealized gains. Second, the stablecoin cycle index generating a sell signal, which in this cycle fired on September 22nd, 2025, exactly 14 days before Bitcoin reached its all-time high of $126,272 on October 6th. Third, long-term holder distribution rates accelerating above $1 billion per day sustained, the level that Glassnode identified as the peak distribution signature in both the 2021 cycle and the 2025 cycle. These signals are not perfect. The Pi-cycle top indicator, which uses the 111-day simple moving average and the 350-day simple moving average multiplied by 2, accurately called the tops in 2013, 2017, and April of 2021, but missed the November 2021 peak. Every on-chain indicator has failure modes. The purpose of using 3 simultaneously is to reduce the probability that any single failure mode determines your exit decision. The sum of everything in Layer 1 and Layer 2 must equal 100% of your current Bitcoin position. The allocation between them is your decision. What is not negotiable is that both layers are defined in writing before the next major market move. Layer 3, the Reacquisition protocol. This is the layer that almost no exit strategy content addresses, and it is where the real long-term compounding difference in returns between holders is generated across multiple cycles. After distributing any portion of Layer 2 at rung 1, rung 2, or rung 3, you have a specific problem that most holders do not anticipate. You now have capital outside of Bitcoin, and no written framework for when or how to put it back. Without a reacquisition protocol, one of two outcomes is nearly inevitable. Either you never buy back, you watch the next cycle begin from the sidelines, convinced that the price will come back to where you sold, until it has doubled from your exit price, and the psychological barrier to re-entry has become insurmountable. Or you buy back reactively, driven by FOMO at exactly the wrong moment, purchasing at prices higher than where you sold, defeating the purpose of the distribution ladder entirely. The Kraken data is unambiguous on this. 84% of holders have acted on fear of missing out at some point. The reacquisition protocol is the structural defense against that pattern repeating itself after a disciplined exit. The protocol has 3 components, each of which must be defined in writing at the same time you define layers 1 and 2. The first component is a price level framework. You identify specific price levels based on major on-chain cost basis clusters visible in the UTXO realized price distribution data, not on intuition or chart patterns, where you commit to reacquiring a predefined percentage of what you distributed. These levels are set in advance. When Bitcoin reaches them, reacquisition begins automatically, without deliberation, exactly as the distribution ladder triggers automatically at its rungs. The second component is a time-based accumulation schedule. Independent of price, you commit to deploying a fixed percentage of your distributed capital back into Bitcoin on a regular schedule, weekly, bi-weekly, or monthly, across a defined window of time. This component exists specifically to protect you from the paralysis of waiting for a perfect entry that the data suggests may never arrive. It ensures that even if you miss the exact bottom, you accumulate meaningfully across the range where the bottom forms. The third component is an on-chain signal trigger that initiates or accelerates reacquisition. The RHODL ratio, the realized HODL ratio, is currently reading approximately 4.5 as of early May 2026. That is the third highest reading in Bitcoin's entire history. The only 2 comparable prior readings occurred at the cycle bottoms of 2015 and 2022. Both were immediately followed by sustained multi-year bull markets that delivered returns of multiple hundreds of % from the bottom. This is not a price prediction. The RHODL ratio is a structural signal about the composition of the holder base. Specifically, it measures the relative proportion of supply held for extended periods versus recently moved coins. A high RHODL reading tells you that the coins in circulation are increasingly concentrated in the hands of long-term conviction holders who accumulated at lower prices and are not currently selling. When that reading reaches historically elevated levels, it has consistently marked accumulation phase conditions that have preceded the next cycle's appreciation. The reacquisition protocol does not require you to know whether the bottom is at $34,000 or $50,000 or $60,000. It requires a written commitment, made today when your emotions are neutral, that prevents you from standing on the sidelines while the next cycle begins without you. The bear case for the system itself. If Bitcoin rallies to $200,000 in this cycle or the next without a major corrective phase, if the exponential move simply continues from current levels, executing layer 2 distribution at lower rungs means you will have less exposure to the final appreciation than a pure holder would. You will watch a portion of those gains occur in a Bitcoin position you have already partially exited. That will feel bad. That feeling is the price of the system. You are trading upside optionality for capital protection, emotional stability, and the mathematical certainty that some portion of your gains will be realized regardless of what the market does next. Whether that trade is worth making depends entirely on your financial situation, your time horizon, and your honest assessment of your capacity to hold through a 70 to 80% drawdown, of the kind that has occurred in every single Bitcoin bear market without exception, without capitulating. The historical data is clear: minus 93% in 2011, minus 86% in 2015, minus 84% in 2018, minus 77% in 2022. Every cycle, the magnitude of the drawdown has declined somewhat, consistent with market maturation and growing institutional participation as a stabilizing force. But the drawdowns have not stopped, and there is no structural guarantee that the next one will be smaller than the last. The system does not eliminate that risk. It gives you a framework for surviving it, and for remaining in a financial position to benefit significantly from what comes after it. Why people who know this still will not do it. Everything in this video is built on publicly available information. The Glassnode data is accessible to anyone with an internet connection. The historical drawdown figures are documented in research papers from NYDIG, Fidelity, and dozens of institutional sources. The behavioral patterns, FOMO at tops, panic capitulation at bottoms, 88% regret, have been replicated across surveys in multiple countries and validated in peer-reviewed academic literature on behavioral finance. And yet, the vast majority of Bitcoin holders will not execute a written system for this cycle or the next one, not because they lack intelligence, not because they lack access to the information, but because building a system requires accepting a specific, uncomfortable truth about the nature of your own decision-making under pressure. The truth is that you cannot time the top. Nobody can. The stablecoin cycle index sell signal in this cycle fired 2 weeks before the peak, not at the peak and not after it was obvious. Acting on that signal required selling at approximately $110,000 while the price was still rising, and the prevailing narrative was that $150,000 was imminent. That feels like selling too early. That feels like leaving money on the table. That feeling is exactly what the system is designed to override. The truth is that distributing at $100,000 and watching Bitcoin go to $126,000 feels like failure in the moment, even when it is precisely correct execution of a pre-committed plan. The truth is that reacquiring at $60,000 after selling at $100,000 feels like capitulation, even when it is the mathematically logical output of a reacquisition protocol that you designed in advance when your judgment was clear. In 2021, long-term holders who began systematic distribution at $60,000, well below the eventual cycle peak of $69,000, executed correctly. The holders who waited for what they were certain would be a higher top held through the subsequent 78% decline from $69,000 to $15,479 over 12 months, from $69,000 to $15,000. That is not a small miss. That is a complete annihilation of unrealized wealth accumulated over years of patient holding. The system does not optimize your returns in the hypothetical scenario where you also happen to time both the top and the bottom perfectly. Nobody does that consistently across multiple cycles. The system optimizes your returns in the realistic scenario. The scenario that the behavioral data confirms is the default, where you are a human being who will experience fear, greed, uncertainty, and the relentless noise of market commentary telling you to do the opposite of whatever your pre-committed plan says. The single most common execution failure. In every cycle, the most common reason that holders fail to execute their distribution ladder is not that they disagree with the concept. It is that they set their triggers too high. They build a plan, or a mental approximation of one, that calls for distributing at $150,000, $200,000, and $250,000. These targets feel reasonable during a bull market. They are based on analyst forecasts, model projections, and the compelling mathematical logic that Bitcoin's previous cycles have delivered returns of multiple thousands of percent from the bottom. And then the market reaches $100,000 and retreats, as it did in this cycle, reaching $126,000 before declining to current levels around $81,000, and the entire distribution framework never activates. Every single rung of the ladder was set above the actual cycle peak. The holder is left with a position whose maximum unrealized value was 40 to 50% higher than current prices. No capital recovered, no reacquisition protocol active, and no written plan for what to do next. The solution is to set triggers based on your actual entry price and your actual cost basis, not on aspirational price targets derived from the most optimistic projections in the market. If your average cost basis is $30,000, a trigger at $60,000 represents a 100% return on your original investment. That is a significant, meaningful gain. It merits executing rung 1. If your cost basis is $15,000, rung 1 at $30,000 is still a 100% return. That is the number that should determine your trigger, not where you hope or believe or calculate that Bitcoin might eventually go. Do not allow the narrative of where price might go to prevent you from locking in the gains that are real and present right now. The practical implementation. Building this system requires one focused session, not a week of research, not a month of deliberation. One session with a document, a calculator, and honest answers to 6 questions. Question 1, what is your average cost basis across your entire Bitcoin position? Question 2, how much total Bitcoin do you hold? Question 3, what percentage is your never sell core? Write a specific number, not a range, not approximately, but a specific percentage that you commit to. Question 4, at what multiple of your cost basis does rung 1 trigger? This is not a price. It is a multiple. 2 times your cost basis, 3 times, 4 times. The multiple should be realistic given where the price currently sits and where the historical cycle data suggests meaningful appreciation is possible. Question 5. At what multiple does rung 2 trigger and rung 3? Question 6. What is your reacquisition framework? Specifically, the price levels, time schedule, and on-chain signal conditions that initiate accumulation after any distribution. Write the answers in a document. Date it. Share it with one person you trust, a partner, a friend who also holds Bitcoin, anyone who can serve as an accountability reference when the market starts moving and the temptation to deviate from the plan becomes real. Then do not look at it daily. Review it quarterly. The system is a decision architecture designed to remove you from the position of needing to make judgment calls in real time. Checking it every day reintroduces exactly the daily decision-making pressure the system was built to eliminate. Where we are is TUMBAS, the honest picture. As of May 2026, Bitcoin is trading at approximately $81,000, 36% below the October 2025 all-time high of $126,272. The market has passed through several distinct phases since that peak. In November 2025, 2.8 million Bitcoin held by short-term holders moved underwater, the largest such concentration since the FTX collapse. In February 2026, Bitcoin touched $60,001, the lowest level since the early stages of the 2023 recovery, with sentiment reaching extreme fear readings not seen since the Terra Luna collapse of May 2022. Since that February low, Bitcoin has recovered approximately 35% to current levels. The 14-day simple moving average of realized profit by long-term holders with supply older than 1 year is running at approximately $180 million per day. That figure is significantly below the $1 billion per day peak readings of late 2025, meaning that the distribution pressure from the oldest, most experienced, and most systematic holder cohort has meaningfully moderated from its peak levels. The structural signals worth monitoring. 2 on-chain readings are particularly relevant for a holder trying to calibrate a system in the current environment. The first is the ARCH-ODL ratio. As of early May 2026, it is reading approximately 4.5, the third highest level in Bitcoin's history. The only 2 comparable prior readings occurred at the 2015 cycle bottom and the 2022 cycle bottom, both of which were immediately followed by multi-year bull markets delivering hundreds of % in returns from the bottom. This is a structural signal about holder composition, not a timing tool. It tells you the coins in circulation are increasingly concentrated in patient, long-term hands. What it does not tell you is when the next appreciation phase begins. The second signal is the short-term holder NUPL, which, according to Glassnode data from January 2026, has been indicating net unrealized losses for the STH cohort since November 2025. Historical precedent across prior cycles suggests that broad demand-side risk appetite tends to remain suppressed until this metric flips back above 50%, a level that, as of the most recent available data, requires Bitcoin to reclaim approximately $98,000 to achieve. These signals are not recommendations. They are inputs for a reacquisition protocol, data points that help you understand where in the cycle structure the market currently sits. The bear case you must factor in. Noodles Research's April 2026 analysis, using NUPL currently at 28.6% in the Optimism zone, the loss supply deviation metric, and the stablecoin cycle index, maintains a base case that the cycle bottom has not yet been reached. Their central estimate places the bottom between $34,000 and $50,000, arriving between July and October 2026. Fidelity's quantitative framework from Jury and Timmer suggests 2026 is a dormant year with structural support between $65,000 and $75,000, meaning even the more optimistic institutional view does not project a return to the prior all-time high in the near term. If either scenario materializes, the holders with no written reacquisition protocol will either hold frozen, unable to act rationally as prices decline, or will capitulate at the point of maximum pain. The holders with a written system will execute their reacquisition framework at predetermined levels, accumulating methodically at prices the 4-cycle historical record suggests will resolve significantly higher over the following years. The system works in both the bull scenario and the bear scenario. That is the point. Before you close this video, open a document. Write 2 things. First, the exact percentage of your Bitcoin that is your never sell core, not approximately, not between 50 and 70%, a specific number that you commit to. Second, the specific multiple of your cost basis, not an absolute price, but a multiple that triggers rung 1 of your distribution ladder. Those 2 numbers are the foundation of the system. Everything else, rung 2, rung 3, the reacquisition protocol, builds from those 2 anchors. Comment below with your never sell core percentage and your rung 1 trigger multiple. Not primarily because the algorithm rewards engagement, though it does, but because writing a commitment in public creates a specific form of accountability that writing it privately almost never generates. The comment section of this video is your first accountability structure. The next video in this series covers the 3 on-chain metrics that define the system's triggers, NUPL, or HODL, and the stablecoin cycle index, in full technical detail, with historical readings mapped across 2017, 2021, and the current cycle. How to read each one, when each has been accurate, when each has failed, and how to combine them into a distribution trigger framework that does not overfit to past cycles in a way that makes it useless for the next one.